Good afternoon, everybody, and for the next 45 minutes or so, I'm going to be walking you through a presentation that talks about technical studies and giving you some context to that and how in turn you can better understand that and also as an investor help it to inform you in your investment decision making. So right at the outset, what I'd like to first discuss and give you a bit of a flavour is some context for the resources sector, and this applies pretty much globally. As you can see up here, I've got a little plot of complexity versus time. And my observations looking at all of the resource projects around the world is that we've reached an inflection point where the level of complexity is increasing over time. And this applies to almost every commodity and almost every country that I see for the resource projects. And you can see there a number of reasons why they're becoming more challenging, and I'll go into them in the next slide in some more detail. But it's across a range of the technical aspects that encompass a mining project, starting with the geology and the ground, and moving through to the softer areas, which are things like environmental and social license, which is becoming more and more prominent in all of the projects globally. If you think that's a bit too theoretical, then I've got 4 examples to walk you through from around the world that really illustrate or help to illustrate just how the projects are becoming more complex over time. The Adani project you may have heard of is a potentially large open cast coal mine that's being proposed for development in Queensland and Australia. And as you can see here, there's a big groundswell of protest against it. And a lot of that protest is because of the environmental and the social uncertainty. And it's got a lot of attention to the extent that it's not yet confirmed whether that project will go ahead, but a lot of the issues around that environmental and social license. Down below that is a graphic of a gold mine in Australia, and the point here is that the gold mines used to be relatively shallow in Australia, but over time, as they're mining out the resource, the gold price has stayed relatively buoyant, the mines are becoming deeper. And what you can see here is the mine that's in the example is pushing down towards 2,000 meters below surface, which is now starting to get into the realm of depth, and the stresses in the rock increase over time, as does the temperatures down there. So another more challenging project over time as we move forward. The picture of the ocean next to it is in the South Atlantic, and that's in Brazil. So you may be aware about 2 years ago the Samarco tailings dam breached and failed, and as a result there were a number of lives lost, and also the tailings washed some 600 kilometers down the river and into the ocean. And again, this is another example where these incidents are happening globally, and it does impact on the environmental and social license that we as the mining industry have to go forward. The 4th example is a potential underground project in Australia. It's about 1,400 metres below surface. And if that were to go forward, that would have to contend with temperatures of up to 85 degrees Celsius down there. So very deep and challenging from a working conditions, a rock temperature environment. So that's the sort of stuff that's out there that confronts us in the industry and is making it more technically complex going forward, and what you need to be aware of in terms of investments about sort of how to look out for those things and how to be aware of the risk around that. So you put all that together, and it really means that in addition to having something that's potentially valuable in the ground, so there's a lot of tons, it's got a good grade, and therefore it's potentially got the in situ value. It's also going to make it more difficult, not so much, well, it could be difficult, but definitely time consuming to get these projects understood properly through a study process. and then also getting them through to potential lenders in terms of securing funding. So at the end of the day, that will take a lot more time going forward just to handle the increasing complexity and get it through to a final funding position. Looking at the studies in a little more detail, the first question to explain or answer would be, why do we do studies in the first instance? And if you have a look at the little rosette here, and I'll start at the top and just give you an overview on each of these elements. It really starts with doing the evaluation first. And that evaluation can be done for either internal resources or external resources. Once that is done, the next step is using the results of that evaluation, and somebody like a potential lender will look at that and they'll look to understand the project to in turn understand the technical issues around it, and in particular the risk and how that impacts their level of potential funding that they could offer the project. A big thing that goes along with that is the risk profile and understanding the risk profile. So when a lender or you as an investor is coming in, you need to be aware of the risk profile. Does it meet your criteria? Is it manageable for the company? Can it go forward with a degree of success? On the basis that the funding is then secured, then it becomes an issue of execution planning. So we're moving from the stage of we've done the study and we're now looking to construct the mine or the operation, whatever it is, and take it forward into production. So one of the key things that a study should have as a component of it is a detailed execution plan that says, okay, on the basis we get funding, how are we going to then proceed with it from construction through into production ramp up. At the end of the day, when the project is completed, it's constructed and it's producing, we always need to refer back to the production metrics, the performance metrics, the things that we said in the study that the whole project was based on. It's going to deliver X tons, X grade, and X ounces of metal, whatever it is we're producing. We need to be able to refer to that as a performance metric and say, is it achieving the goals that we set out to? So those half a dozen elements are really some of the key elements that are really out there to say, why do we need to do these studies in the first place? As you're probably aware, there's a continuum of value chain elements starting from exploration at the front and ending with closure at the end of the mine life. The studies really typically fit in that assessment phase here, which is the area where you're looking at what's in the ground and you're evaluating it and you're seeing how it can best sort of be developed and turned into something that's going to generate money and value ultimately for any of the relevant stakeholders. So what I want to do now is explore that value chain in a little more detail and to understand how the studies fit in across that value chain in the assessment phase. This is a busy plot here, but there's a couple of things in particular that I want to go through and discuss how they interlink here. The blue curve is showing project value over time, and the red line is showing risk over time. You can see at the top of the plot there that really mimics the previous slide, so it's showing you exploration through to production and ultimately closure in terms of a sequence of events for a project. And if we walk through the blue line, you'll see that sort of tracks through the study phase. On the previous plot, it really just had an assessment box there. Well, within the assessment are these studies, in particular the scoping study, the pre-feasibility study, and the feasibility study. And this is where a sequence of three ideally studies would be carried out. And what happens is over time, and you'll see in the next couple of slides, over time, you improve the value by progressively learning more and more about your deposit in your project. And in doing so, you look at the risk line, and as you learn more and more information and hence are in a position to increase the project value, the other benefit of learning more about your project over time is that the risk decreases over time. So you can see the project value increases over time, and conversely, the risk, which is a good thing, drops over time. The other thing to note there is when you talk about mineral resources and ore reserves, the placement on the graph here gives you a rough indication of where those take place. So the resources generally takes place early on in the value chain when you're discovering it in the ground and quantifying it and qualifying it. And then that takes over by doing further work, typically at least a pre-feasibility study and a feasibility study. And then you define an ore reserve out of that, which is ultimately the most economically definable portion of the resource, which is then we call the reserve. In terms of the study stages we had a look at there were three studies: the scoping study, the pre-feasibility study, and the feasibility study. Just to unpack them a little more, the scoping study is the least immature of the phases of three studies. And it's really about what it could be. And the reason why we say what it could be is because we don't have a lot of information typically at those stages. There's a lot of ambiguity, it's at the very start, and we still need to collect a lot of information going forward. So it gives you a very sort of broad general answer initially. However, as you move up that value chain, you get into a pre-feasibility study, which is all of a sudden you've got an increased level of knowledge, and you have a look at a number of options. And that could be typically 2, 3, maybe 4, but typically probably closer to 3 options that you're looking at across a number of technical areas, and you're evaluating them with a view to distilling it down to one defined option that you would take forward to a feasibility study. And at that stage, as we say there, you'd be looking at one option, in other words, a frozen scope, that you do a final evaluation on and complete a feasibility study, which you would then normally take forward to secure funding for a project based on it having a demonstrable project value. To frame those series and sequence of studies, there's a number of guidelines. And I'm just giving you 3 examples from what are really known as in the industry as the most senior guidelines out there and the most well-accepted codes that we've got. The first one is JORC, which you're probably familiar from in the Australasian context, so that falls under the AusIMM in Australia. And the JORC 2012 is the code which is applicable to mineral resources and ore reserves. If you go across to North America, and companies that are in particular listed on the Canadian stock exchanges, they're required to fall under and comply with the NI 43-101 code. And that is similar to JORC, only a little more prescriptive in terms of the content in there, but they both serve the same purposes. Similarly, if you go across to South Africa, you fall under the SAMREC codes. And the SAMREC codes are quite similar to the JORC in terms of content and layout. So altogether, these are internationally accepted codes which set the framework for the studies, and in particular, you can see the NI 43-101 reports are all publicly listed on the CEDAR website in North America, and an increasing amount of companies publish the JORC report, or JORC compliant feasibility and pre-feasibility studies and so on. What you see here now is a matrix that describes and gives you some background as sorts of things that you should be looking for, that a company has complied with when they are completing studies. A couple of things to point out here is the top row, moving from left to right, is really walking you through the sequence of studies from a scoping study on the left to a feasibility study on the right. And looking down the page, you can see rows of various technical elements. And what this does is really just gives you the level of requirements that need to be completed for the various technical areas depending on what level of study you've got. So moving from the left-hand side of the page, you need sort of less accuracy because you have less information. Moving across to the right-hand side of the page, you're sitting with a lot more information, and therefore you need to do a lot more detailed analysis in the studies. So companies that are well run and doing a quality level of project evaluation and analysis for their project should have these sorts of matrices which then guide the level of study that you do for a particular project. I mentioned before about the accuracy, and what this slide speaks to is the various levels of accuracy. So again, there's that value continuum starting with scoping on the left through to feasibility on the right. And in particular, I'd like to talk about two things here. The first is the range around the central estimate. And you can have a look here, and I was talking before about the level of ambiguity that you can get in a scoping study just through the lack of information. And you can see that for a scoping study that the potential range of outcomes is 30, sometimes even plus or minus 50%. 30 to 50 is not abnormal for that just because you don't have the required information. However, as you move through the value chain up to feasibility and definitive feasibility, you can see the accuracy gets a lot better, plus or minus 15%, plus or minus 5%. And that means that you've got a lot more certainty of outcome because you've got a lot better information. And that is backed up when you have a look at the next row down, which talks about the level of design effort. And again, you can see under the scoping study, very little design effort goes in because you just don't have the information to do anything credible. However, as you move across to the right, you've got a lot more information, and in turn, you're doing a lot more design work, a lot more design man-hours to work through the detail of a project to support the cost and schedule around that. That leads us to the value pyramid. And what you can see here, working from the bottom to the top, is everything leads to the pointy end, which is looking at your ultimate project value, so NPV, net present value. Down the bottom, we've got what I'd call the foundation elements, and these are all the technical areas. So you've got your resource, your mine planning, and so on. All those foundation things that you've got to have in place and got to have properly evaluated to have a good project. When you've done that work, it then starts leading up into the financial aspects. So you can look at your revenue generation and your recovery from the products that you're producing. You need some operating and capital cost evaluation in order to get your financial inputs for your financial model. Surrounding that, you can see there's the social and environmental. And these have become increasingly important in projects all around the world. And projects these days don't go very fast anywhere unless those softer issues, the social and environmental issues, are handled in parallel with all the hard technical areas. Because at the end of the day, the NPV is only secure in terms of outcome if all of those issues have been equally treated and considered in a technical study. When we do a technical study, the aim should be to get a central outcome for the results of our study. which means in simple terms it should have a 50% chance of success or a 50% chance of failure, but simply put, upside, 50% chance of upside, 50% chance of downside. And there's three key elements there that you can see there: the cost, schedule, and risk that we look at to see if it's a balanced outcome, if it's not too biased. I do a lot of corporate advisory work where I'd come in for lenders, and we do a project evaluation on a various number of projects. And one of the ways that we, as SRK, as independent reviewers, look at this is we will look at the base case financial model and the technical work that the project owner has done, which is really represented by the financial model 17 column there. And we look at that, and then independently we come to our own conclusions, which is the SRK base case. Now, sometimes we may agree because we think, yes, it's a central estimate. We may agree with what the owners put forward. But in some instances, we may not agree, and in turn, we'll put forward what we believe should be the base case, which means that we're now saying that, no, we don't believe the owners got a central estimate there. We think it should change for whatever reason. Then there may also be an instance where we see that, yes, okay, we put forward a base case, but we still believe that there's some ambiguity in the system. And that's where we recommend the stress case that you can see there on the right-hand side. And that's an option for lenders to consider because we're unsure, we're not necessarily comfortable with the base case playing out all the time. We might say to a lender, we might recommend to them, look, we think you need to set a stress case at sort of plus or minus 5%, 10%, 15%, whatever the number is that's relevant to the technical aspect. So that's a very good example of how we do our project evaluations for lenders and how in turn we come to an assessment on a project and make recommendations to them for how they should model it as part of their lending evaluation. I talked before about the complexity, and there's about typically up to 20 elements within a typical project study process. And just choosing one of those 20, in particular geology, and I've chosen that because that's always the most critical. It's the very first thing that we launch a project on, and it's arguably the most important because that's what's in the ground in the first place. And what you can see here on the plot is looking at geological continuity on the bottom x-axis, and then the proportion of mineral on the vertical axis. And basically, it's a busy plot, but what it's telling you is that depending on the commodity, they're all different, and there's no one size fits all. Each geological setting is unique in its own right, and we have to analyze it that way. The elements that need to be analysed listed there, the bullets for the mineral resource evaluation. You can see there's a number of points there, and they all have to be analysed, and it starts from, first of all, drilling holes in the ground, logging the core, assaying the core to find out how much mineral's in there, and then doing a lot of modelling and simulation work to ultimately say how many tonnes are in the ground and at what sort of grade or metal content. So there is a very detailed sort of process that needs to be gone through just for the geology and the mineral resource alone. And that's the same essentially for all of the other up to 20 elements in a study process, and they need to be all done in parallel. When we do that, one of the most important things for the study team to ensure that we get a quality outcome is that everything is done in balance. And what I refer to a thing that we call the triple constraint. The triple constraint is as you can see there, we've got an equilateral triangle, and an equilateral triangle is one that's in balance. Each of the sides is equal. Each of the sides is represented by the three things there: the schedule, the cost, and the scope of work. In the ideal world, all of those things have got to be absolutely in balance to make sure that we've got the optimal quality when we do a study. Because if any of those things are out of balance, then you're going to get a suboptimal quality outcome for your study. The other way to illustrate that is if you've ever been to South Africa, you've maybe seen one of these pots. We call them a potjie pot. Big cast iron pot that you put over a fire and you cook your food in there for 2 or 3 hours. As you can see, that potjie pot has got 3 legs on it. You can imagine it's sort of analogous to what I'm talking about for the triple constraint. If the legs aren't secured properly or they're uneven in length, then you risk the pot falling over and you spilling all your food out, or it not going as well as you thought. So, end of the day, everything's got to be in balance. One of the things that's becoming more important from a governance point of view, particularly for the financial lenders, is the equator principles. And as you can see here, the equator principles is something that looks at environmental and social risk. And as you'll see, it covers 10 elements, and these 10 elements are a number of assessment criteria that the lenders in particular use to assess a project on. Most of the international banks, the majority by a long way around the world, have all signed up to the equator principles, and in all the project evaluation work that we do, we're asked to comment on that. Here you can see the 10 elements, and they run through from a number of things there through to the end to the reporting and transparency. So the way that we evaluate these things is basically a traffic light sort of compliance. And worst case is the criteria are non-compliant, so the company is not compliant to what they should be doing against each of those criteria. Or they're under development, they recognise that they've got shortcomings, but they're working through it with a view to finally getting compliant. So, as I said, the banks, more often than not nowadays, are asking us to comment on that, and we give them basically the traffic light scorecard against that. In a lot of instances, the banks these days will not lend against a project unless they can demonstrate a degree of compliance, or as a minimum that those criteria are under development with a view to becoming compliant. As we move through the value chain of analysing a project, a key point that's got to be done throughout the project is to understand the risk. And here is, and this example is well to the right-hand side of the curve of sort of what can go wrong in a mining project, but you're looking at a open pit wall failure that occurred a number of years ago in Utah and the USA at the Bingham Canyon open pit. That's large scale copper mine. You're looking at a pit failure that had towards 200 million tonnes of dirt that sort of flowed down. You can see it slip down the sidewall and into the open pit. That ended up delaying the operation of the mine for about a year while they reassessed and reconstructed access to the bottom of the pit. So that sort of reinforces the need to do good risk assessments throughout the project. And what you can see here is a bit of an analogy to the way risk assessments, or the way that you've got to be careful that when you're doing a risk assessment that it doesn't turn out this way. A key thing when you're doing a risk assessment on a project, all the various elements that you're looking at have got to be treated evenly. Because if you don't treat each of the elements evenly and assess it evenly, then you end up with a difference in outcome. And as you can see here, you've got a mixture of steel links there, which are obviously very strong, and you've got a shoelace in the middle, which is obviously very weak. So if you're not looking at each of the elements across your project in an even-handed manner, you risk on incorrectly or misunderstanding the risk profile within a project, which means that that weakest link then becomes the rate determining step in the outcome of your project. So very important that we look at all those things evenly. It's also very important that we look at everything throughout the whole value chain of the project, starting with the study, through to construction, into operation, and then as we do our sort of annual planning cycles throughout the life of mine plan. To describe what we do for their risk assessment, there's two key elements to be aware of that you need to look at when you're judging a project, and the risk in particular. The first one of those is the consequence. So when you're looking at a particular risk, you assess two things, the consequence and the likelihood. The consequence is how big is the issue? You know, what could go wrong? Is it something small that could go wrong, or is it something large that could go wrong? Similarly, you look at the likelihood, and the likelihood is how often will it happen? Is it something that you're going to be exposed to every single day as the project operates, or is it something that's going to be quite rare and may only happen possibly once a year? So you can see those in the matrix at the bottom there. Those are the sort of two key framing elements to that. And when we look at individual risks across the whole of the project, we analyse them for likelihood and consequence. Depending on the score of that, it gives us an outcome. And you can see the red colour in the top right-hand side of the matrix there. That's giving you the extreme risks. So ones that have a high consequence if it happens, and a high likelihood. Whereas you go down to the bottom left-hand side of the matrix there, and those are the very low-risk elements that happen very rarely, and if they do, they have a very low consequence. So you will see that in any good project would have had that well analysed, and it would be very transparent for everybody to understand the risk profile. At the end of the day, those risks all translate into a number of areas which we see time and time again happening across all of the projects. Any of those 6 areas that happen, they all have a common theme, and they all translate into a dollar impact. They might be wholly financial in nature or purely technical in nature, but the common outcome of all of them is that it impacts the financial side of things. Now, I've got some case studies coming up to illustrate those points, but all of these points happen time and time again to a lesser or greater degree on projects all around the world. So what I've got to finish up on is 3 case studies. 2 of them are positive to illustrate some of those points there, and 2 of them are negative to start off with, and 1 is positive at the end. So the first case study to work through is was an iron ore mine in Australia. To give you a bit of background for that, it was remote, as most mining operations are in Australia. It had a very complex geological setting for the project, what I call disrupted, so it wasn't a nice, thick, continuous setting for the iron ore. It was less mature and very fragmented. Coupled with that, it was quite low grade relative to some of the richer deposits that, say, Rio Tinto or BHP own. Where they were mining it was over 100 kilometres from the mine site to get it to the coast, where they had to ship it. So they had a road train network to transport the ore. And then when they got it to the coast, they needed to transship it. So that means they had to load the ore from the road train into a barge, take the barge out into the open sea to an ocean-going vessel, and transship it from the barge into the ocean-going vessel. So a lot of moving parts there on top of a disrupted geological setting in the first place. The outcome of that was that the study that was done was over-optimistic, and there was a number of issues which clearly hadn't been analysed properly, and in turn they hadn't understood the risk around the project and how to best mitigate that risk. One of the key things that became apparent when the mine started operation was it was harder to mine because of the higher complexity geological setting. And that in turn made the issue even more challenging when the ore was out and then they had to process it. So they were processing it to look to upgrade the ore before it was shipped. As I said, it involved road trains and transshipping, which is complex logistically and made that very challenging. At the end of the day, the lender that had put forward the funds at a point in time after watching what had happened withdrew the funding, and that mine ended up failing and is no longer. So a very good example of a number of key risk elements that weren't correctly understood at the time, and because they hadn't been understood, there was inadequate mitigations in place to potentially set it up for success to make it work. The next case study to talk to is a platinum mine in South Africa, and this is one that I worked on a number of years ago. So we were mining platinum at depth, so we started 1,200 metres below surface and went down to about 2,300 metres below surface. Similar to the previous example, it was a highly disturbed piece of geology. The Merensky Reef that we're mining there is typically quite a continuous sort of plane of reef, but where our mine was, it was very disturbed, and you can see here in the figure on the right-hand side of the slide, the sequence of reef that's got MP2 and P2 and FW footwall P2 is quite undulating. It was a very rich piece of platinum bearing mineralization, but geologically very interrupted and made it difficult and challenging to mine. The other thing that made it challenging, and where I lost part of my hair early on in my career, is we had a new set of technology and hydropower, and this was something that we needed to help us mine at depth and also to handle the high temperatures down there. The picture you see on the left-hand side of the slide there is a picture of one of the hydropower drill rigs that we had there, and these were powered by very high pressure water. Coupled with that, from a revenue point of view, this was at a stage where Russia had a lot of platinum and palladium. They had a very big, large stockpile, and they were selling this onto the global market. That kept the platinum price depressed, and for many, many years it stayed down at about $500 a ton, and was quite some time before it sort of rebounded and moved up to over $1,000 an ounce. So that was the backdrop. How did that end up? So the company I worked for had deep pockets, and they were very well aware that we were using this cutting edge technology and did want to make it work. So that wasn't an issue. You know, failure wasn't an option because we really needed to make it work. But what it did do is made having positive cash flow very challenging for a period of time. So they needed to provide a lot of financial sustenance to keep things running. And one of the reasons why we needed to do that was to keep that technology running as well, and really make sure that we made a success of the new hydropower technology. At the end of the day, one of the things that led into the challenging cash flow options deficits was, we had lower than planned production, and took us a lot longer to get up to speed with the production rates. End of the day, as I indicated using my hair as the example, it gave us for a very stressed, or it led itself to a very stressed workforce there. So everybody was under a lot of pressure to make this thing work. It was going on for a long time, and it wasn't the best sort of place to work at. However, we did get through the challenges and we ultimately made a success of it. And that mine, as I stand here today, 20 years later, is still producing. However, it does go well, and I want to finish up with one positive story, and there are many positive stories out there. It's just the negative ones are always a bit easier to illustrate the points and why we need to be careful. This positive example is a polymetallic operation in Asia, so it's within our own orbit here. Polymetallic is talking about multiple commodities. So this operation produces up to 5 different commodities as a final selling product. As I said, it's Asia. In particular, it's in a developing country setting, not perhaps the developed country that we're standing here today. With that, it most definitely had a challenging political setting as a backdrop that everybody who was living and working there had to live with. In particular, where the mine was located had a lot of community challenges, and by that I mean where they were setting up the mine in the original location was surrounded by communities, housing people. And what happened before they could, as they were developing and before they could start developing, they had to relocate a lot of people, which meant addressing farmland issues, addressing property ownership issues, and relocating communities into adjacent areas that weren't going to be impacted by the mine site. Coupled with that, on the technical side, it was a very challenging processing flow sheet that was required, and that came about because there were so many minerals that they were trying to recover. It wasn't just a gold mine where you'd perhaps just be focusing on one element. They had to focus on 4 or 5 elements at a time in parallel, so made for a very complex processing plant. However, the outcome out of that was that it was a good success. As I say here, when I look at that mine, and I've said to a number of people around the world, is you could quite happily take that whole operation and transplant it to any first world developed country and show them just how it can be done in that sort of setting, which was very challenging. And one of the reasons why it was so successful was around the people issues there. And there's a saying that I learned very early in my career, and it goes around people make the difference. And I think if we have a look in life, we'd apply that to a lot of things in life. But in particular, to this mine site, it was really applicable. And that was in particular across the leadership. So everything lives and dies by the quality of leadership on a mine site. And the leadership team was very aware of what needed to be done, how the people in the community need to be handled, how it needed to be set up for success. And then going down below the leadership, another thing that was really helped the project go well ultimately was the training that was applied. So you were taking a novice, a virgin workforce, literally out from the paddy fields there, and putting them into a much higher tech mining environment. And one of the things that the owner did was a year and a half odd before the mine came into production, they took the potential workforce and they'd taken essentially one person from each house that was affected by the operation. And they took them into the workforce and they set them up on a very structured training process, which took them into other mine sites within the country to learn how things operated and how it could be applied at the mine site that was being set up. And that really set them up for success in terms of, in particular with the processing to make it go well. Community engagement that was part and parcel of that. On the pure technical side, building an operation like this in that setting and having a complex flow sheet was challenging. And one of the things that really helped that project was what I call the construction agility. And that was the ability of the owner's team in particular to handle any of the curveballs that came up, any of the challenges, the problems that came up. And because they in turn had worked in that environment for a long time, they were able to manage that change very effectively to ensure that pretty much the mine was built a little over budget and a little over time, but definitely set up for success to produce. So at the end of the day, looping back to where we started with the studies, they are really important, and you can see here through a range of outcomes why they're important. And if we really focus on a lot of the elements that I've talked about and walked you through here, then we can get a good outcome as we do a study, and we can make the process of setting up building a mine, of ramping it up to production and settling it down at a steady state production a lot easier.